Hey everyone, welcome back for another deep dive with us.
It's great to be here.
Today we're digging into high-yield dividends.
Always a hot topic.
Absolutely, and specifically we're looking at those in the Dow.
Yeah. Makes sense. The Dow Jonesers. It's a good place to start if you're looking for some reliable dividend payers.
Right, and we've got some interesting data from the Motley Fool.
Oh, yeah? What's that?
It's their list of the 3 highest-yielding Dow stocks as of January 3rd, 2025.
Okay, I'm all ears.
So the companies are Verizon, Chevron, and Amgen.
That's a pretty diverse mix.
It is, and that's what makes this deep dive so interesting. Each company has its own story, its own strengths and weaknesses.
Definitely a lot to unpack there.
Okay, so let's start with Verizon.
Okay.
I mean, they're a telecom giant, practically synonymous with cell phones and internet service here in the U.S.
Yeah, they're everywhere.
And they've got this impressive track record of 20 straight years of annual dividend increases.
Wow, 20 years. That's commitment.
And get this, their current yield is 6.8%.
Whoa, now that's a yield that'll get your attention.
It definitely does. But I'm guessing there's more to the story.
Right, there always is. So what should we be thinking about when we evaluate a company like Verizon?
Well, their capital expenditures are massive. Just massive. The telecom industry demands constant investment just to keep up.
Oh, absolutely. Think about 5G, all that infrastructure.
Right.
Verizon invested billions.
Yeah, and it's not just 5G. They have to upgrade their fiber optic networks, acquire new spectrum licenses. It never ends.
No, it doesn't.
Yeah.
And all of that translates into a pretty hefty debt load.
Okay, so that's where the cautionary tale comes in.
Yeah, their debt-to-equity ratio, it's higher than a lot of their peers.
Uh-oh, so that means...
Well, it means that we might be a little more vulnerable to economic downturns or, rising interest rates.
I've heard some analysts even say that Verizon's debt levels are unsustainable.
I've heard that too. It's definitely a point of concern.
But how do you reconcile that with their long history of dividend payments?
Right. Well, it basically means they have to walk a tightrope. They need to generate enough cash flow to service their debt and keep those dividends flowing.
So tempting yield, but you really got to look under the hood.
Exactly. High yield doesn't mean high return if the fundamentals aren't there.
Okay, so we've covered Verizon's high wire act with their debt.
Uh-huh.
Yeah.
Hey, I like that analogy.
Now let's switch gears to Chevron in the energy sector.
A completely different landscape.
Totally. What stands out to me is their integrated business model.
Ah, yes, that's a key strength.
Can you break that down for us? What does integrated even mean in this context?
Basically, it means they're involved in every stage of the energy process, from exploration and production finding and extracting oil and gas, all the way to refining, turning that crude oil into gasoline and diesel, and then finally marketing and distribution, getting it to us, the consumers.
So they're not just relying on oil prices, which are notoriously volatile.
Exactly.
Yeah.
That diversification helps to smooth out the bumps in the road.
Interesting. So how does Chevron compare to its main competitor, ExxonMobil, especially when it comes to dividends?
Well, both are giants in the industry, but their yields tell a different story. Right now, Chevron's sitting at 4.5%, while ExxonMobil is at 3.7%.
So Chevron has the higher yield.
Interesting.
Yeah.
Why do you think that is?
Well, Chevron's performance hasn't been quite as stellar as ExxonMobil's lately.
Ah, so the markets may be a little less optimistic about them?
Could be. But, businesses have ups and downs. Chevron's got a long history of success, so this might just be a temporary dip.
And didn't they try to acquire Hess recently?
They did, but it hasn't been smooth sailing. They've hit a few snags.
Oh, what happened?
Well, there's some resistance to the deal, and some of it's actually coming from, you guessed it, ExxonMobil.
Oh, wow. So there's some corporate drama playing out there.
A little bit. But even if this Hess deal falls through, Chevron's got options.
You think so?
Oh, yeah. They've got the financial firepower to pursue other acquisitions.
So maybe this dip in their stock price is an opportunity for long-term investors. That's the question, isn't it? Is the market overreacting to these short-term challenges?
I guess time will tell.
It always does.
So we've got Verizon with its debt burden and Chevron with its potential for growth. Now let's dive into the world of biotech with Amgen.
Okay, but buckle up. Biotech can be a wild ride.
Amgen, our final company for today, operates in a complex world that not every investor might be comfortable with.
You're telling me, if you're not ready to dive deep into medical research and drug development, Amgen might not be for you.
But for those who are willing to do their homework, Amgen has a pretty impressive story. They've developed some life-saving medications, and they've consistently increased their dividend for 13 years.
Yeah, that's solid track record. And their current yield is nothing to sneeze at either. It's at 3.6%, which is actually on the high end of their historical range.
That's definitely eye-catching. But I'm sure Amgen has its own set of challenges.
Of course. Every company does. Amgen's been facing some headwinds lately, mainly competition from biosimilar drugs.
Biosimilar drugs. Could you explain what those are for our listeners who might not be familiar?
Sure thing. Think of them as generic versions of biologic drugs. They're basically very close copies, but they're much cheaper, which puts pressure on the original manufacturers like Amgen.
So they're like a budget alternative.
Exactly. And on top of that, Amgen's pipeline of new drugs has been kind of lackluster lately, and some of their recent drug launches haven't lived up to expectations.
So they're getting squeezed from both sides, competition from biosimilars and a lack of exciting new drugs.
Pretty much. It's a tough spot to be in.
So is Amgen's high yield a sign of trouble or a potential buying opportunity?
That's the million-dollar question. We'll have to delve deeper into their story when we come back.
Stay tuned, folks. We'll be right back with more on Amgen and the rest of our high-yield Dow stocks.
Welcome back to our deep dive, folks. We left off talking about those headwinds facing Amgen, that biosimilar competition, the lackluster pipeline, and those new drug launches that didn't quite meet expectations.
Yeah, it's a lot to juggle.
It is. Can you give us like a real-world example of how these biosimilars are hitting Amgen's bottom line? Oh, sure. A prime example is Neupogen. You know, that drug that helps prevent infections in chemo patients?
Yeah, I've heard of it.
Well, it used to be a blockbuster for Amgen, bringing in like $4 billion a year just a few years ago. Now with biosimilars on the market, their sales have been cut almost in half.
Ouch, that's gotta hurt.
It does. So yeah, biosimilars, they're a real threat.
So for investors trying to make sense of all this, what should they be looking at when they evaluate a biotech company like Amgen?
Oh, it's not just about the yield.
Yeah.
You got to look deeper at their existing drugs, their pipeline, their financials, their management team, and the overall competition.
So a lot of homework?
Definitely biotech's not for the faint of heart.
Okay, so Amgen high yield, but potentially high risk. Let's swing back to Verizon for a minute. You mentioned earlier their huge capital expenditures and that massive debt load. Can you paint us a picture of what those investments actually look like?
Sure. We talked about 5G, right? Billions upon billions to build out that network. But it's not a one-time thing. They've got to keep investing in fiber optic networks, keeping those internet speeds high.
Makes sense.
And then there's the spectrum licenses. Those are essential for wireless service, and they don't come cheap.
So it's like a constant treadmill of spending just to stay in the game.
Pretty much. And that's where that debt comes in.
Okay, so for a long-term investor like me focused on dividends, should I be sweating bullets over Verizon's debt?
Well, it's definitely something to keep an eye on. A high debt-to-equity ratio. Yeah, you can make a company more vulnerable to economic shocks, but you also got to consider their track record.
Which is?
They've been increasing their dividend for 20 years straight. That says something about their ability to manage their debt.
So maybe not panic, but definitely watch closely.
Exactly. Don't ignore the debt, but don't write them off either.
Okay, good advice.
Yeah.
Now back to Chevron. You described their business model as integrated earlier. What does that mean for those of us who don't speak oil and gas?
It means they're involved in basically every step of the process. They explore for and extract oil and gas. That's the upstream part.
Okay.
Then they refine that crude oil, turning it into gasoline, diesel, jet fuel. That's downstream.
So they're not just drilling for oil, they're doing it all.
Exactly.
Right.
And finally, there's marketing and distribution, getting those finished products to consumers and businesses all over the world.
So a very diversified approach.
Very. Which helps to cushion them against the volatility of oil prices.
Smart. We talked about Chevron lagging behind ExxonMobil lately. What are some of the reasons for that?
Well, historically, Chevron's been more of a risk taker than ExxonMobil, more willing to make those big bets on new projects.
So sometimes those bets pay off, sometimes they don't.
Exactly, and that can lead to periods of underperformance compared to a more conservative player like ExxonMobil.
So their attempt to buy Hess, that's a good example of that risk-taking approach.
It is. They were hoping to gain a bigger foothold in the Permian Basin, but it's been a bumpy road.
And some of those bumps are courtesy of ExxonMobil, right?
Yeah, you could say that their pre-existing relationship with Hess has complicated things for Chevron.
So is Chevron's dip a buying opportunity or a warning sign?
That's for each investor to decide. It all depends on how you view their long-term strategy and their ability to execute.
Some food for thought for sure.
Definitely.
Well, this has been an incredibly informative deep dive. We've only scratched the surface of these companies, but I feel like I've learned a lot.
Me too. There's always something new to discover in the world of investing.
Absolutely. Before we go any further, though, let's recap some of the key takeaways from our discussion about Verizon, Chevron, and Amgen. And then we'll wrap things up with some final thoughts for our listeners. And we're back, wrapping up our deep dive into high-yield Dow stocks. We've been talking about Verizon, Chevron, and Amgen, exploring those juicy yields and all the complexities that come with them.
Yeah, it's been a fascinating look at three very different corners of the market.
It really has. So as we get ready to sign off, let's try to distill some key takeaways for our listeners who, might be thinking about adding these stocks to their portfolios.
Sounds good. I think the biggest takeaway is that dividends, they're not a guarantee. Companies can cut them or even suspend them, especially if they hit a rough patch.
Makes sense. So what should investors be focusing on?
Well, you want companies with a solid history of dividend payments, but just as importantly, a sustainable business model, when they can support those payments for the long haul.
Got it. So sustainability is key. You mentioned the payout ratio earlier. Can you remind us what that is and why it matters?
Sure. The payout ratio tells you what percentage of a company's earnings they're paying out as dividends. So if a company earns $1 per share and pays out 50 cents in dividends, that's a 50% payout ratio.
Okay.
Now, a high payout ratio, say anything above 75%, can be a red flag. It might mean the company is struggling to maintain its dividend and might not have much room to increase it in the future.
So lower is better in this case?
Generally, yeah. You want to see a payout ratio below 75%?
Yeah.
That means they've got some cushion, even if earnings fluctuate a bit.
Okay, so payout ratio is definitely something to watch. What else should investors be thinking about?
Well, growth prospects are huge. A company with a high yield but no growth might not be as appealing as one with a lower yield but stronger growth potential.
Because you're looking for that total return dividends plus the potential for your shares to increase in value.
Exactly. And, as we've seen with Verizon, Chevron, and Amgen, they each have a different mix of yield and growth potential.
Right. Verizon's got that tempting yield, but they're also wrestling with that big debt load and fierce competition.
Yep. And Chevron, they've got a long history of success and a diversified business, but they seem to be in a bit of a transition phase right now, figuring out their place in the evolving energy landscape.
And then there's Amgen Solid, yield a strong track record in biotech, but they're facing those headwinds from biosimilars and the inherent uncertainty of drug development.
It all highlights the need for due diligence. You really got to do your homework before investing in any of these companies.
Couldn't agree more. The more you know, the better decisions you'll make. The Motley Fool suggested that these high-yield Dow stocks present a good opportunity for investors as we kick off 2025. What are your thoughts on that?
It's an intriguing thought. The Dow is known for stability and long-term returns. And the three companies we've discussed, they're all big players in their industries. Yeah, they definitely have the potential to reward investors who are patient, but past performance is never a guarantee of future results.
Right.
The market can be unpredictable, and there are always risks involved.
So proceed with caution.
Absolutely. Don't chase yield blindly.
Yeah.
Do your research to understand the company, understand the industry, and always remember diversification is key.
Great advice. Well, this has been an eye-opening deep dive. I feel like I've learned so much about these high-yield Dow stocks and, more importantly, how to evaluate dividend-paying companies in general.
I'm glad to hear that knowledge is power, especially when it comes to investing.
Couldn't agree more. Well, that wraps up our deep dive into high-yield Dow stocks. Thanks for joining us, folks. We'll see you next time.